Hey guys, David Robinson here. Welcome to the Lead Sponsor Podcast. As usual, we've got another great guest for you today. I'm excited to bring you Kevin Bupp. Kevin leads the strategic vision of SCI and hosts two top-ranked real estate investing podcasts. His real estate investment advice has been downloaded millions of times by folks in over 190 countries with 150 million of real estate transactions under his belt. He's got an incredible amount of experience. He's been investing in real estate for 20 years, and we dive in today to his backstory, sort of how he got into the space, started in single family, went through the Great Recession, learned a lot during that time, and eventually pivoted to commercial real estate, where initially he was focused on multifamily, but really become an expert in the mobile home park space. And so we actually get a chance to talk about how he's invested in mobile home parks as well as parking assets, so mobile home parks, parking assets, and most recently, build-to-rent single-family home communities. And we get to talk about all three of those asset types, how he's been able to build a team to navigate those different asset types. Many investors stay focused on one specific asset type and become an expert in that space. And we talked to Kevin about how he's been able to broaden his horizons a little bit with strategic partnerships. And so we talk about that. We talk about some of his insights about what's happening in the market today and where he sees things going in the future, considering that we're on the cusp of a recession, and his thoughts about the biggest risks during a recession and some tips on how to mitigate that. So I really enjoyed my conversation with Kevin today. He's a wealth of knowledge, and I hope you enjoy the show. So without further ado, Mr. Kevin Bupp. All right, Mr. Kevin Bupp, welcome to the show. I appreciate you coming on and spending some time with us.
Yeah, David, thanks for having me here. Excited to be here.
Yeah, my pleasure. So I've already mentioned a little bit about your background in our intro, but if you don't mind, just give our listeners just sort of a brief synopsis about your journey in the real estate world, what you were doing maybe possibly before you got into real estate. And I mean, you've been at this thing for a very long time, but give us a brief synopsis of what your journey has been like and what your world looks like today.
Yeah, we'll do, David. And so I always like to joke and say that real estate found me. I didn't really find it. So I feel very grateful and blessed, back at the age of 19, an individual who ultimately became my mentor, introduced me to the world of, rental real estate, more specifically, at least in that phase of my journey was single family and small multifamily properties. That was basically his business model. And I didn't really want to reinvent the wheel. And so I basically worked underneath his tutelage, I guess you could say. I attended bar and went to school, and in my downtime, I basically was with him at his office or out in the field, wherever I need to be for free, basically looking to help him in any way possible in exchange for me, getting a better understanding of the business and just literally learning a completely new craft. I mean, I didn't know anything about real estate. And so, that journey basically led me to buy my first property when I was 20 years old. It was a single family property in the town I grew up in, which is Harrisburg, Pennsylvania, and invested in Pennsylvania for roughly 2 years before moving down to Florida, which is where me and my family are based today. We're down in the Tampa Bay area. And so, that's when things really ramped up. I basically took what I learned up in Pennsylvania for a couple of years and really, Tampa is a much larger market, just much more progressive in nature, a lot more things going on, more people moving to that area, a lot more in migration patterns than where I grew up. And so it allowed me to really scale that business in a fairly significant way. In my early 20s, I was able to accumulate about 130 single family rentals and a few hundred multifamily doors. And I really, again, I was never looking to reinvent the wheel. That model seemed to work at that point in my life. And but at some point in time, I started noticing some inefficiencies with just the management side of the single family business. Our portfolio is kind of spread out amongst roughly 6 counties, basically north of Tampa by about an hour and south of Tampa by about 3 hours. And so there was a lot of inefficiencies that existed. And I started to realize that the multifamily stuff I had just ran better. It seemed to be a lot more cost effective to run the day-to-day operations. Times have really changed. Technology has definitely changed the efficiencies of managing single family real estate. Back then it was, I don't know, there weren't many there weren't a lot of the opportunities of just like doing virtual showings and virtual lock boxes and things of that nature. So anyway, I really started putting my emphasis more on the multifamily and also some other commercial assets. I really started kind of leaning towards, again, a more efficient model. This is in like my mid 20s, and then ultimately that runs you up to 2008. Florida was an absolute bloodbath. During the Great Recession, as were a number of other states. And every market kind of handled that time differently. At that point, Florida was a very different market than what it is today. It's much more economically diverse. Back then, a lot of the jobs were related to construction. A lot of builders were building inventory that, was for a population that wasn't really, they were building more inventory than the population that was actually migrating in. And then ultimately, when the real estate, crash happened, a lot of those construction jobs went away. And so we had this glutton of inventory, brand new inventory all throughout Florida. And so that created a lot of challenges with our rental model, because ultimately what happened is, these builders started renting these homes that they couldn't sell. Mm-hmm. And folks could ultimately rent a brand new home for, not much more than what they were renting a 20-year-old home that I owned. And so we had to lower rental rates. We had to give concessions. It was just a very, very challenging time. And so, fast forward, we ended up working through the recession. We lost some properties and we did the best we could, right? It was just a really, really tough time. A lot of banks weren't willing to work with us in the beginning. Banks didn't even know what the hell was going on, right? They didn't have loss mitigation departments. They weren't prepared for the crisis that ultimately came out of that great recessionary period. And so, fast forward to roughly 2011, I took about a 3-year hiatus between that. I wasn't actively buying real estate. I was really in damage control more than anything else, just trying to keep the pieces together, keep the wheels on the bus. And in 2011, I really had a moment of self-reflection and really wanted to rebuild things, but again, wanted to start with a good, solid foundation and do it in a more efficient manner. And at that point, I knew multifamily was going to be the way, or just commercial real estate in general, but multifamily was going to be the path I was going to take. But that slightly pivoted after a conversation I had, and that's what led me to mobile home parks. So we've been, investing in mobile home parks for roughly 10 years. Long before they were, an attractive asset to many other investors. Now, for the past 5 years, it seems to be, like the darling investment. And so mobile home parks have kind of been our bread and butter. But we've started buying parking assets a few years back. So we own parking garages and parking lots. And then most recently, just looking at the long-term macroeconomics of where, the population growth with the in-migration in certain markets, shortage of housing being the big one, we've been really attracted to the build-to-rent sector. And so, most recently, we've got 4 different projects happening in various markets in Phoenix, in the Phoenix metro, building, A-class, higher end build-to-rent product there. And so we're really excited about that niche, and just it's got the best risk-adjusted returns at present of any other niche out there today. And we literally have such a massive shortage of housing. We're ultimately looking for a way to fill it. And so we kind of hit both sides of the spectrum. We've got affordable housing in the multifamily or in the mobile home park space. And then we have, more, I guess you could say, white collar housing in the build-to-rent sector. And then we, again, also buy parking assets. And so I'll stop there. I'm sure you probably may have some clarifying questions. I kind of rambled through that very quickly, but that's in a nutshell, the last 20 years that I've been investing in that. You asked me what I did before real estate. I didn't really, I always like to joke and say I never had a real job. Attended bar in school, and that was basically about as real as it got, and that wasn't very real.
Yeah, you and me both. I was roughly 19 years old as well when I was fired from my first job. My employer happened to be my dad at his small mechanical engineering firm, and that was the day I knew that I was destined to sort of go my own path. But well, thanks for that background and sort of the synopsis of combining the last 20 years into a couple minutes. I know that's hard to do from time to time, but a couple pieces I want to dig into a little bit. I do want to take you back to the 2008 recession. And I don't want to bring up any horrible memories, but I think that there's a lot to learn from someone like you that was in the trenches during that time. And maybe just give our listeners at a high level some insights into what you learned from that experience and how what you're doing today could potentially help you navigate a future recession. Here we're recording, just for reference, mid-July of 2022. Many think that we're already in a recession. If not, it should be announced here pretty quick. But maybe give us some insights into your experience way back then in single family space with a large portfolio spread out to what you're doing today, and how you feel like you may be able to weather that storm a little bit better than the past.
Yeah, and I'll start by saying that like back then is very different to today, right? And one of the biggest differences is the massive lack of housing that we have in this country. That wasn't necessarily a thing leading up to 2008. We had the complete opposite problem in most marketplaces. Florida being one of the big ones, California, Las Vegas more specifically. I'm sorry, Nevada more specifically, Las Vegas, and a few other select markets. Every market across the country kind of felt the impacts of the Great Recession in one form or fashion or another. But those states that I just mentioned, those markets really were markets where builders were just building like crazy and just building rooftops for populations that weren't necessarily here. So we have the complete opposite problem today. And so with that being said, you know, I don't necessarily see any type of major price corrections, like property values dropping by 65, 70%. Obviously, there's been a number of folks that have been priced out of being a home buyer. In fact, I think that's what's ultimately going to continue fueling the rental market. You've got just with the increase of rates over the last couple of months, you got many would-be, whether they're first-time or second-time home buyers, that ultimately are now either if they were second-time home buyers, they're just going to stay in their existing home that they're in today. They're not going to sell it. Or the would-be home buyers that were renting an apartment, now they saw their dreams vanish before their eyes, because there's still incredibly sufficient demand for the products that are out there on the marketplace. It just took them out of the running to actually be that person that owns that home. And so they now find themselves in a situation where maybe not lifelong renters, but ultimately are going to be put into that rental pool, and they weren't there prior. And so anyway, just got this massive demand for housing that we have not been able to fulfill. And per the data, it shows that we've been running at a shortage each and every year of the actual number of units we need to get out of the ground on an annual basis. And even if we could hit that number, we'd still be like 10 years behind the trend. And so, I mean, it's going to take, more than a decade to make up for the shortfalls that ultimately have accumulated since the Great Recession. I mean, basically that's kind of when all this started, when builders have stopped, there wasn't a lot of liquidity. We had an excess supply of inventory that kind of worked its way through the system, but builders didn't get ramped up soon enough, to really start, making headway into supplying the amount of housing that's necessary. And so, I think that if you're in, single family rentals, I think if you're in that business or you own multifamily property, so long as you're in a great market, right? Like the market, every market's different than the next. So long as you're in that, in a good solid marketplace, I think you will be absolutely fine. Now, with that being said, I still think that there's, really good ways to be prepared for, the unforeseen, outfall or unforeseen circumstances that might come. And what I've always, I've had many mentors tell me this in the past, and it's just something that we've come to really work into our philosophy at our company is there's truly only one thing that if you go through a challenging time with any particular property you have, there's really only one thing that can absolutely make a good deal into a bad deal, or make it to where you find yourself in a financial bind to where you're giving that property back to the bank. And it's the debt piece, right? It's the debt piece, understanding that the mechanics of the debt of that particular property, not being in an over leveraged state, really having a longer term forecast. If you're a long-term investor, but yet you went and tied on, floating debt or 3 to 5 year debt to where you're going to have to refinance in a couple of years, not knowing what the capital market's going to look like. That's when I think folks find themselves in really precarious situations. And so we've been very diligent, and a lot of it over the last couple of years within our company, the diligence has really come from how the last time played out for me. And we weren't over leveraged, but we had different loans that came due in 2010, 2011, when again, it was just really challenging. Banks weren't making loans. And so we found ourselves having to sell properties, fire sell them just to get out from underneath them. And I didn't want to find myself in that scenario again. And so we've been very diligent about, number one, keeping our LTVs fairly low across the board on any deals. Now that does affect the cash on cash returns, but we're stewards of capital with our investors' capital. And so, if we have investors that are looking to maximize their cash on cash returns, and they need to be hitting 20% cash on cash returns or high teens all the time, and they're willing to take the risk to do that, we might not be the right fit for them. We're much of a lower risk investment firm that give very good cash on cash returns, but ultimately our objective is to make sure that their money is safe no matter what type of turbulence that we go through. And so I would just say be very conscious of the debt that you have on the property, and really put pencil to paper on what your plan is for that investment. I mean, truly, if you intend to hold it for a long period of time, do your best. Again, rates are higher now, which kind of you might be slightly behind the trend there, but do your best to to find the best debt product available that's going to give you stability over these, again, uncertain times that might be coming down the pike. So, but I do, with all that being said, I do think that the Fed, we're going to find ourselves in a scenario where they keep pushing rates. I think we're going to continue to see rates go up until they can slow down this massive inflationary period we find ourselves in. But I do think that once we can actually get inflation down to the level they're seeking, 2 or 3%, they're probably going to go back into that quantitative easing mindset and actually lower rates again and try to stimulate the economy. Like, it's just like this never-ending cycle. And so I don't think rates will continue to be in 5, 6, 7% range. I don't think they'll end up being there for 5, 10 years to come. But there will be a couple of years where we've got to work through a time of less liquidity, not so desirable rates. And I think just making sure that your house is in order, financial house, both on the property level, but also on a company level or personal level, make sure all that's in order, and that you've ultimately got the reserves and just the wherewithal to manage through somewhat potentially challenging times. So
yeah, love that insight. Thanks for sharing that. I'm curious, you have quite a wide range of experience with different commercial real estate asset types. I'm interested in learning and hearing about how you've been able to navigate multiple asset types. Many people believe there's power in being very focused and niching down and becoming an expert in a particular asset type, maybe even a geographic region. You've gone a little bit wider and you have a lot of experience. How have you navigated that? Has it been just a keen interest from you in these different asset types, so you've been able to spend the time necessary to really become proficient in them? Or have you gone out and sought out partners in those spaces? Maybe give us some insights on how you've been able to navigate taking part in multiple asset types.
That's a great question. And I'm also a firm believer of niching down and becoming an expert in one particular niche. And so with that being said, a lot of we're general part, we're sponsors, from a company level on 3 different asset types, with Build-to-Rent being the most recent. I'll kind of go into detail of how we found ourselves into that particular niche. But prior to Build-to-Rent, and again, I mentioned parking assets, mobile home parks literally have been the only thing that we've focused on for the past 10 years. Because I believe wholeheartedly in that philosophy of like niching down, becoming an expert. It's really hard to be, really widespread amongst multiple asset classes. Now, I understand many of the other asset classes, from a maybe mid to higher level. I don't have operational boots on the ground, the self-storage space or the medical office space or the retail space, but I've got personal capital amongst all those different asset classes, as well as a number of others. And so I've studied them enough. I've talked to enough operators, understand the mechanics behind the business model, but I don't know it enough to say, hey, we're going to start buying that ourselves and just run that into our current infrastructure. So I rely on teams that are experts, just like we are in the mobile home park space, to really find that wide breadth of diversity in those other asset classes. So with that being said, again, mobile home parks have been our focus for the last decade. Parking was the second one we kind of introduced, and I was introduced to parking just, kind of by accident. I was interviewing someone on my show about 4 years ago, who was an investor as well as a broker in the parking sector, which is, we talk about niche, it is incredibly niche. I mean, there's literally only like a handful of brokers that even specialize in that space. And there's 50,000 parking lots or garages across the country, but it's just, they don't, it's not common mainstream investment vehicle. And just, there's not many institutions in the space. It's fairly fragmented, not very consolidated at all. And so, but anyway, after that interview I had with him, I never had understood the business model. I never tried to, but until I interviewed him, I understood that there was a way to potentially own parking and have it be a fairly passive investment. And what I mean by that is what I saw was that a number of the parking lots or parking garages were owned by a lot of mom and pop operators. They've owned them generationally, maybe they own one, two, or three, but with that being said, either they ran it themselves, but more often what you found is that in any particular market, so name Tampa, there's no less than 10 professional operational companies, management companies that manage parking, whether it be a surface lot, a garage, a valet for a hotel, what have you. And so we saw that as an opportunity to not necessarily to be able to invest in a new asset class, had a lot of similarities to mobile home parks, but not necessarily have to build out the infrastructure on the operation side, which is really where the expertise lies from the front end, understanding the business model, underwriting it, and understanding how to execute in that business plan. That is much easier than that of running the behind the scenes day-to-day stuff. And so parking is an asset class that, we've purchased roughly $35 million of parking over the last, 2 years. And we have not hired one additional person in-house to manage that side of our business. We handle the asset management, but ultimately we have professional operators in those various assets that run the day-to-day, and they would do it way better. That is their business. They don't own real estate. They just manage real estate, just like in multifamily, right? Buy a large multifamily property in Texas or Florida, there's no shortage of professional operators that will do the job probably much better than you would yourself. Mm-hmm. And so that's allowed us to go into this secondary asset class without, again, having to, build an entirely different vertical inside the company. And then lastly, with the build-to-rent, build-to-rent is no different than that of, at least a finished product of build-to-rent is no different than that of rental real estate, rental residential real estate, whether it be an apartment or a single family home that you have scattered across the portfolio or a mobile home park. And the development piece of it is the part that is unique in nature. And so we have partnered with a development group that's got 20 years of experience. They're based in the Phoenix marketplace. I've actually known the main principal for 5 or 6 years. We're great friends, and ultimately that partnership was born out of really a desire for us to expand upon our portfolio of residential real estate. Mobile home parks have been fairly challenging to scale since a lot of institutional capital is poured in, and so we have not been able to deploy as much capital as what we had hoped for in that space over the last 2 years. Build to rent is just an incredibly desirable sector all across the board. However, that development piece was always kind of the unknown for us. And so we brought a partner in that has that expertise. And our role in that partnership is mostly on the equity piece of it, bring the equity to the table. And then ultimately they're handling the development aspect of it. And that allows us to get brand new A-class product in phenomenal markets and ultimately offset the risk of the piece of the puzzle that we didn't necessarily have a ton of experience in, which is the development piece. And so that's how we've been able to kind of, again, diversify amongst 3 different asset classes. But those are the core. Again, I've got personal investments in a lot of other types of assets, but it doesn't necessarily require me to be an expert in each one of those to make a good investment decision.
Yeah. And to speak a little bit deeper on the structure, mobile home parks has been your bread and butter. You've been in that space. I think we would all consider you an expert. You'd probably consider yourself an expert in that particular asset type. In the parking asset space, did I understand you correctly that you are the lead sponsor on those deals, but you're hiring professional management? Is that correct? Or are you partnering with a professional operator who's also a general partner in the deal with you?
No. We're hiring. We are the general partner, and we're basically hiring professional management. And in both most of the structures that we have in place. Again, another piece I kind of left out, but either way, it's kind of important to hit on now that you're back to parking is the assets that we currently own today are triple net leases with the operators, and so they've got company guarantor on it. I mean, and they're companies that we've vetted. They've been around for many years. They've got a strong balance sheet. And so it's the equivalent of why maybe a CVS or Walgreens triple net lease is very attractive, or an anchor grocery anchored retail center with a national grocery chain is attractive to a lot of investors. So that's the relationship that we have with the different operators we work with. Now there might be some of those have like some incentives or some kickers once they hit certain performance metrics, but the majority are just simple triple net leases, and they're the guarantors on it.
And so the management demands on the parking assets is pretty limited the way that you have it structured. The
That's
build to
correct.
rent, obviously, you have plenty of experience in the residential rental
Hmm.
space. So, management and operations on that, no problem. It was really the development piece that you were
Correct.
missing that you brought the partner in on that. That's great.
That's correct. Yeah, I mean, I
I'm
think
curious.
it goes
Yeah.
back to like being, being aware of like where your skill sets lie, and then wherever you have weaknesses or voids, like finding that individual or individuals that has the expertise to fill that void, and that's how a great partnership forms.
Yeah. Um, I'm curious about the equity raising side of being in multiple asset types. Have you
Mhm.
found that obviously your investor network um, was very accustomed to investing in your mobile home park
Mhm.
opportunities? Did you find that their interest crossed over to the different asset types, or do you find that you have investors that really just want to stay in your mobile home parks, others that are interest in your parking, others that are interested in your build to rent, or do you see them crossing over?
It's a mixed bag. We've got some that are just kind of siloed in each respective asset class, and then we've got a number of investors that are across, all of our funds, right? They've allocated capital to each and every one of our funds, and so, and I don't think it's necessarily, and I think with a lot of, and I'm not going to speak for every single one of our investors, but I can kind of speak to how I feel when I'm in like a limited partner position, looking to invest in with another group, and I think it's more related to, I mean, the asset class is important, right? Like, so don't let me get that wrong. Like, it's incredibly vital, but it's also related to the sponsor team and the track record, and just their overall investment philosophy, and if that's in alignment with that particular limited partner. So again, we've got a number of investors that I know personally that that we spent a lot of time with over the last 5-6 years that have invested across all the respective funds that we have that are, again, very varied in nature, mobile home parks. And then our last fund was a mobile home park parking mix between the two. And then the most recent fund that we just
Mm.
launched is a build to rent fund. And at this point, I mean, they love the storyline behind build to rent. They understand it, they can comprehend it. They might not have, maybe if it was a brand new sponsor, maybe they wouldn't have done it because it's development, and maybe they don't understand that as well. But they understand our track record. They know and understand how we make decisions. I mean, we're very slow to make decisions. Like, we don't just haphazardly go to a conference and say, we're doing build to rent. Let's find someone here that we can work with and roll forward. So I think a lot
Right.
of the trust gets placed more in the sponsor than the deal itself. So,
Yeah.
but anyway, I don't know if that answers your question or not,
No,
but yeah,
that's
it's a
great.
mixed bag across the board.
Sure. So let's talk a little bit about build to rent. It's not something that we've talked about extensively. We had one guest a few months back that touched on it, that was working on a project in the Austin, Texas market. You've focused on the Phoenix market. I have some ties to Phoenix. I was born and raised on the west side of Phoenix, so
Okay.
very familiar. And as I've visited, I've seen some of these projects going up. I'm curious, can you just describe for us what a build to rent single family project looks like, just for those listeners that aren't familiar?
Yeah, and they come in a variety of forms, and
Sure.
so the very first build to rent projects, it's not a new asset class per se. It's been around for roughly a decade, but initially a lot of these build to rent projects that came out of the ground. In fact, Phoenix is kind of like the birthplace of it, which is interesting. Were more horizontal apartment complexes. A lot of them had a very similar floor plan to that of an apartment, similar square footage, but they were more of like, depends what market you're in. They're called either patio homes, the single story villas. I mean, again, many different names for the same type of product, but that was kind of the original build to rent project or product that was out there. Nowadays, you've got entire single family subdivisions that are purpose built, that have amenity packages, swimming pools, community centers, just like the really nice A-class high end apartment complexes have. But these are single family detached, 2-car garage, 3 or 4 bedroom floor plans, small backyards. But again, the entire community being a build to rent community, purpose built with professional management in place. And then the projects that we're working on, so that's detached. And the projects that we're working on, we've got 4 at present time, that are all townhome projects, but these are in
Mm.
urban infill locations. And so these aren't, on 40 acres swaths of land on the outskirts of town where the growth is going. We're basically taking parcels of land in very key neighborhoods, some of the most desirable neighborhoods in Phoenix, and essentially building anywhere from our smallest projects is a 21 unit These are, 3 bedroom, 2.5 bath, 2 car garage, smart garages on them, rooftop decks, things of that nature, really high end, purpose built townhomes. And so that 21 units is the smallest one. Our largest one will roughly be 55 units in nature. But these are all in like main on main locations, walkable to restaurants, shopping, boutiques, things of that nature, in some of the most desirable neighborhoods in Phoenix. And so, but again, I think kind of circling back, one of the unique aspects of the build to rent space that these homes are literally built with a rental mindset. They're not built for sale and then ultimately turned into rentals thereafter, which is what most of these single family rentals are that we come across, right? Like they were built for sale at some point along the line. Maybe someone did buy a brand new and they just rented it, but a lot of times it was probably owner occupied up until a certain point, and the investor came in and ultimately turned it into a rental. So, a lot of the the finishes and fits that we put in them are a little bit more durable than that of a typical standard, builder grade. And so anything from like the flooring material to the cabinetry to the, the quality of the faucets, the garage door, all those things we put a little bit more thought into so that it can withstand, the different turns that happen with your renter base. And so, but that's just like from a high level, that's what build to rent is. I mean, we're building residential product, but again, with the mindset that it's going to be living and breathing as a rental from day one.
Yeah, love it. And just at a high level, what are your thoughts on why this is becoming such an asset class or an asset type or a project type that more and more people are becoming more focused on? What's going on in the market that's driving the demand for that?
Well, back in, following, coming out of the Great Recessionary period, we had just a glutton of single family home inventory out there. Blackstone came along, I believe it was in 2011 or 12, which ultimately they became, Invitation Homes is what ultimately spun out of that. But they started gobbling up all these single family properties. There's this massive inventory of these single family homes they continue buying today. And, originally their business plan they didn't think that this was going to be a long-term hold. In fact, there's been many times that the CEO way back then say that it was going to be more of a accumulate, fix up, get them rented and flip. And what they realized is that these assets ultimately have outperformed most of their other real estate assets that they have investments in. But what occurred then is that inventory was all bought up, right? Like between them and other investors, like we've absorbed all this excess inventory that was a, kind of carryover from the Great Recessionary period. And in order for them to continue scaling that business model, it's either buy one here, buy one there, just continue that scattered model across the country, or let's look at developing a new product from the ground up. And so really, the challenge with that is that, a lot of these investment groups, they don't want to be developers. They don't want to run that side of the business. Like that's not part of their risk profile most of the times. And so, and there's not enough developers at present time actually building new communities. Again, like I said, we're not keeping up with the current demand for housing in this country. And so there's just this massive supply demand imbalance. Like, they're lining up with billions of dollars. There's multiple funds out there that have billions and billions of dollars that are looking to buy entire subdivisions, build to rent, anywhere from 10 units all the way up to thousands of units, but the inventory, it's not there. And the people are needing a place to rent. So like the demand for the rental units is there, the demand for the actual, physical properties themselves or subdivisions, it's there, but not enough people are actually building them. So we're kind of at the front end of a trend at present time. I always like to compare it to, in mobile home parks 10 years ago, we were way at the front end of the trend. In fact, I'm not going to act as though like I knew we were in front of a massive trend. I loved the asset class 10 years ago, but I did not foresee a day when institutional capital is going to come in and start buying these things at 2.5, 3 cap rates, right? But that's ultimately what's occurred over the last 5 years. And so we found ourselves in the front side of that wave and have been able to, provide just incredible returns on a lot of the assets that we've exited out of as a direct result of that. Prior to that, it was just mom and pops, selling to other mom and pops, right? Or selling to other small investment groups, not institutional. And so that's really where the supply demand imbalance has come from, the build to rent space. And so, another attractive factor, I think that develop both institutional players and guys like us are seeing is that we're not, when you buy a scattered portfolio of single family properties across the board, not only does that create some inefficiencies, right? When you got them in these different neighborhoods, but you're also buying a used product, right? It's got,
Hmm.
it's got plumbing and electrical that, is 10, 15, 20, 25 years old. Whereas when you're building it from the ground up, like again, you can purpose build the product, but also you're getting a brand new product that literally has never been lived in before. And so there's something to be said about that, starting fresh, solid foundation, and not necessarily having a used product that's been used and abused over the last 15, 20 years. So
Yeah. Thanks for that insight. Well, look, I want to start winding down here a little bit, but I've got a few final questions for you. The first is, what's the biggest challenge that you're facing right now in your business that we could learn from?
yeah, that's a great question. And I think it would be, like I said, I alluded to this already in the mobile home park space. I'm incredibly bullish on that asset class. Love it. We'll continue buying it. Is the ability to scale. There's just, it's hyper competitive at this point in time. And again, there's no new inventory coming on the marketplace. It's one of the only asset classes that has a diminishing supply. And so there's more mobile home parks that either get redeveloped or just, whatever, torn down on an annual basis than there are that new inventory that come on the market. And
Mm.
so, but yet every year we find new investors, whether they're groups like us or larger institutional groups that are vowing for the same deals. And so it's just, it's grown hyper competitive to where, again, I wasn't speaking out of context when I said that, cap rates, depending on the park and the market that it's in, I've seen these things trade in sub 3% cap rate range. And so, which is just it's really challenging to make money when you're like, we have retail investors, and so our blended cost of capital is somewhere in like the 7% range. Institutions, they've got different sources of capital. A lot of times their cost of capital is much less than ours. So that, I'd say, scaling our mobile home park business to the size that we would like it to be is probably the biggest challenge in our business. But with that being said, I'm equally as excited about just what we have. We're slow and methodical buyers. We'll buy the good opportunities that come along. And then in the meantime, we'll be able to build brand new product with the build to rent. So I'm so excited about that, because like we can build not as much as what we want, but like we can build in the markets we want to be in. We don't necessarily have to, mobile home parks kind of drive you all across the country. You basically go to where the deal is. Now we just go to the market and we make the deals there, which is a very attractive incentive for us. So, but yeah, scaling in the mobile home park space, I'd say that's probably one of the biggest challenges that I think that we're facing as a company today. But so.
And on the flip side, what's something that you're just absolutely crushing right now in your business that we could all learn from?
Yeah, no, that's a great question as well. I think that we've done a good job over the past. I've been doing my podcast for 8.5 years, and I think we love giving back. We love helping others. We love educating, and I think that we've just been really solid at always putting an emphasis on helping others, like not having a scarcity mentality, just looking to add value wherever we can as much as possible. And I think that's what allowed us. It's allowed us to build some incredibly solid relationships with all of our investors, who we've gotten to know over the many of years. A lot of them found us through the podcast, or they found us from a YouTube video, or maybe me being on a podcast. And we're always open to meet with folks that come to Tampa. Like I have breakfast or lunch meetings probably 5 times a month with just whether they're an investor or not an investor, just people that listen to the show and just really looking to help others. I mean, you and I wouldn't be where we're at today if we didn't have the help of others. You've probably had many mentors like I've had throughout the years, and always looking to help someone else get that next step up. And I think that's just on the flip side, has just added tremendous value to our company.
Yeah, love it. Well, look, Kevin, this has been a pleasure to have you on the show. I've learned a lot personally. I'm grateful for you spending the time with us and to share your insights over the last 20 years, and especially your knowledge across multiple different asset types and how you've been able to structure things to be able to get involved in those type of opportunities and create some diversity of investment opportunities for your investor network. Before I let you go, what's the best way for our listeners to connect with you and learn more about what you have going on?
Yeah, no, that's great. I appreciate that. And so you can find me in 2 different places. You can go to kevinbupp.com. There you can listen to my podcast. I've also just recently released a book. In fact, if you wouldn't mind, Dave, we talked about this before, but I've actually got a way for them to get a free copy of the book.
Yeah, love
for
it.
sale for $20 on Amazon. But you go to kevinbupp.com/book. Again, kevinbupp.com/book. You can get a free copy of the book in PDF version right now. So again, you can go to that website and make contact with me. Also join we've got an investment club as well. We can kind of see behind the scenes, the deals that we have coming to the market and learn a little bit more about our team. And then, sunrisecapitalinvestors.com is our company website. So if you want to look more in depth of what we've got going on and the different asset classes that we're in and the markets we're in and things of that nature, you can find us there.
And we'll have links to all that in the show notes. But before I let you go, real quick, tell us about the book. Like what is the the content of the book and what should they expect?
Yeah, it's called A Cash Flow Investor, and basically it's about creating legacy wealth and cash flow and through commercial real estate. It's a culmination of my 20 years of experience in many different asset classes, lessons I've learned along the way, but also I took the many lessons I've interviewed now over, 500-600 people over the years, and some incredibly astute commercial investors that have, decades and decades of experience, and have basically taken all the knowledge, bits of knowledge I've pulled from them and my own experiences, put it into the book. And so it kind of just lays out a fairly straightforward plan of not necessarily just how to get started in commercial real estate, but even it goes granular into a few specific asset classes. In that book, I share, a number of asset classes that I love. We've got some guest writers in there that actually wrote pieces that are experts in those particular niches. And so it's just a good variety of everything and anything related to investing in commercial real estate and actually building a lifestyle out of it.
Love it. And that's kevinbupp.com/book. Go there right now. Click on the link right now in the show notes. Just go down below, click on that link. You'll be able to go to Kevin's website and download a PDF version for free. That's kevinbupp.com/book. Kevin, an honor to have you on the show. Thank you for sharing your time with us and sharing your insights with us. And I look forward to connecting with you again soon.
David, thanks for having me. It's been a lot of fun.